Hello, hi. I'm Arvind Chari. I'm the Chief Investment Officer at Q India UK. I was a Chief Investment Officer at Quantum Advisors. Recently moved to London to get a more global perspective of how global investors are looking at India and India's asset allocation. I'll take you through what I'm hearing and seeing, and when I meet clients, what kind of investment alternatives they look at, and I'll give you a sense of, as NRIs living outside India, how should you look at your investments in today's times? And today's times are really uncertain, right? And investors generally like certainty, and today is a very uncertain world. Like if I take the example of Europe and whatever is happening in Russia and Ukraine, and its impact that has been seen on Europe, it is a very uncertain time, both for individuals as well as for governments and for investors. We do not know the end outcome of this war, and we do not know what kind of socio-politically changes it will bring. Given that this has broken up and it has been more than 6 months that the Russia-Ukraine invasion has been happening. So there is considerable uncertainty from a global investor perspective in terms of the outcome and impact of it on Europe and European investments. And in a globalized world, it doesn't remain restricted to one locality, one region, right? Asset markets and the economy is very much globally linked, and you see the impact of that across all aspects and sectors. The second big uncertainty that I see is where inflation is in the developed world and where interest rates are going to be able to and deal with that inflation. And we've not seen this kind of inflation and this kind of interest rates for about 15 years in the developed world. So a generation of new investors, would not have seen and reacted in terms of how will they react if the cash rate or the US Fed funds rate or the UK Fed funds, Bank of England rate is about 4%. What do you do when money market cash gives you 4%? And how do you price other assets, which are risky assets or illiquid assets? And how do you price those in a valuation context from where you were doing at 0% or 1% interest rate, and today it is at 3, 4, 5%. And that's another cause of uncertainty, and you've seen an impact of that. As I said, it's a globalized world. All assets have corrected. Be it equities, some markets are down 20% YTD. Be it bonds, some bond markets are down 20% YTD. We've seen a large correction in commodities as Fed central banks have increased interest rates to slow down the growth and control inflation. You've seen a correction in commodities. You've seen a large correction in crypto assets. And you're now seeing the first signs of correction in real estate in the developed world, as in UK, in the US, in Australia, in Canada. You're seeing house prices coming down, or house sales activity going down. So these are like fairly broad changes, which was not expected, not seen over the last 10, 15, 20 years. And the investors are now kind of dealing with it. And when you deal with uncertainty, typically the reaction is to just stay away and see what happens, and not commit further capital. And maybe that's what you're seeing, or sell, just sell the risky asset and try to wait in cash, and cash earns you a reasonably good return. In this, we always look at global and then look at India, and India is not an island. Like India is not decoupled. So there are a lot of these things going on about India being decoupled, and fair enough, we have done well relatively in the short term, but we are not decoupled. In fact, our sense is that as India grows and as India integrates more with the Western world and with the global economy, size of GDP, size of trade, size of investment, we'll actually get more coupled. So India is not decoupled. India will get impacted. Indian markets will get impacted. But on a relative basis, there are certain things which are going well for us. Like, say, for example, geopolitics. We are in a fairly tough neighborhood, but we managed those fraught relationships up till now reasonably well. Even in geopolitics, there is a certain predictability of how India will react in a global geopolitical environment. And we've seen that, in the Russia-Ukraine thing. Economically also, I think, given the fact that we've had some 7-8 years of tough activity, low GDP growth, very low real estate prices or falling real estate prices, very low industrial activity. And we've taken some tough reforms, we've taken some tough times, and we're seeing a gradual rebound. So we believe that India is on a cusp of a economic cycle. Bank balance sheets are better, corporate balance sheets are actually very much deleveraged. We are seeing the first signs of residential real estate activity picking up. Land prices across India and many places are actually increasing. And we are seeing real estate activity picking up, and that tends to be a fairly good economic driver. And so when you put these two together, which is some are short term and some are medium to long term, Indian markets, equity markets or bonds do look, attractive. And we also seen the Indian currency not fall as much as some other currencies have done. So that gives a sense of India being decoupled. India is not. India is coupled. India is not an island. But there are certain aspects, there are certain trends, and if policy reforms continue and we make pragmatic choices, we should be able to withstand from the global uncertainty, global shock that we are seeing. Particularly for you, if you're a non-resident Indian living outside India, those pounds. From an asset allocation perspective, there is one generic advice, which is Indian equities. Given the fact that India has grown at 6.5% real GDP growth over the last 30, 40 years, and we believe will continue to grow at that level. When the economy does that, your equity markets or companies' earnings and company share prices tend to compound in lower double digits, and that's a fairly good attractive return if you're invested in the long term. And so, from your dedicated equity allocation, we would believe that a large part of that should be in India. And as the Indian markets stay correct because of this global uncertainty, because of what I said about why we see the economic recovery and the pickup that we are seeing in the economy, and which can last for the next 2, 3, 4 years, it will be a very good time to keep allocating to Indian equities. And if you look at quantum, the 2080 might not completely be applicable to an NRN, but that's a fairly easy framework of allocating in your equities allocation over a long period of time by choosing very simple products. And I think that will always remain irrespective of what conditions you're in. And given the fact that India has taken the reform measures and the hardship, there is some benefit that you will see over the medium term. When it comes to Indian rates, a lot of the non-resident Indians do invest in deposits, NRI deposits. I would say that if you're say from UK or Europe, where you've seen the rupee actually appreciate against the pound or the euro in the last, say, 1 year, and given the fact that Indian interest rates are not as high as it was compared to, say, 2 years, 3 years back, where your bank interest rate locally in pound or euros have also gone up, whereas Indian interest rates have also increased, but not by much. Maybe there could be, as a tactical approach, given the fact that Indian rupee is appreciated, maybe you can think of moving some money from India into from a deposit perspective, if you're just doing NRI deposits, because you'll get the currency benefit and you'll get reasonable. You won't get zero or negative rates that you were getting as the developed world central banks keep raising rates. Your cash deposit or your money market fund should give you slightly higher. I think that's from a tactical perspective. But for everybody else, I mean, if you're a long-term investor and you have long-term investment, approach, then equity should be a large portion of what you do. And Indian rates, deposits or bond funds can only be like a tactical or like for liquidity purposes. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.